Hello everybody, and welcome to the second day of MoneyLab 9 in Helsinki, Playgrounds for Post-Capitalism. My name is Minna Tarkka and I'm director of MCALT, and we are here going to talk about different things, the decentralized finance and governance today. And we will have an open mic as well. We hope you read our site for updates on that. So MoneyLab 9 is a collaboration between MCALT and Economic Space Agency EXA, Institute for Network Cultures, who initiated the network of MoneyLabs, then the fabulous Decentralized Library, and Robin Hood Cooperative.
Hey, my name is Ida, producer at MCALT. So today's session is called What Comes After Decentralized Finance? Hello. And there will be Bryan from the University of Sydney talking with Akseli Virtanen from Economic Space Agency. And the session will be 1 hour long, and in the end there will be 15 minutes reserved for questions from the audience and open discussion. So, yes.
And a short introduction of Akseli, old friend and colleague of mine. So Akseli is a radical economist and co-founder of Economic Space Agency, as well as Robin Hood Cooperative, to put it short. Thanks.
Good. Thanks Minna, and thanks Ida. Dick, good morning from Finland. What's the time in Australia?
6 p.m. and it's dusk, so the sun is just going down now.
Good. Hey, thanks.
You have a pleasant day ahead of you.
Thank you. It is, in fact, a pretty beautiful day over here too. So, thanks for joining me. You know that I've introduced you with this with the same thing earlier, but I don't think we have it on record. So I just want to tell everybody how important you have been, for instance, to my my economic thinking. And there's this, you've written a couple of important books. Risking Together is the latest one, which is, I think, a really important political book. Kim Stanley Robinson has quoted it, used it in his novels, at least the 2 of the latest ones I know. But then there's this one, which I think it was 2005, which you wrote.
Oh, that's Capitalism with Derivatives.
Yeah, with Mike.
That you're struggling to remember.
Yeah. So Capitalism with Derivatives. And for me, it's like a book that there was a time before that and after that, And it was... Seriously, it was an eye-opening book. It opened my understanding of that actually what kind of organizational power the financial technology has, especially the derivatives. What's the subtitle? It's Political Economy of Derivatives, something like that.
Of derivatives, capital, and class, something like that. Yeah.
Now
we're talking 15 years ago, but I think that's right.
Yeah, it was before the crisis. So there's a new book coming up, I hear. Well,
the economic paper that we've been working on in EXA, the plan is that, because this economic paper has got quite extensive, and it needs a serious read, because the program we're developing, the protocols we're designing are quite complex. Because if you imagine building a post-capitalist economy, it's not a simple process. It's got lots of moving parts. So we thought we'd try publishing it as a book with commentaries from people who we think might be positive, but may not. And people who we think will be pretty critical, because we think part of our project is to challenge those people also to participate in debate.
So what is the project? What is the project?
Well, the project that we're participating in is really about saying, for those of us who sort of, to put it simply, don't like capitalism, that we're finding that issues of inequality, environmental decline, the inability to value anything that isn't profitable, or to rely purely on state subsidies to engage things that aren't profitable, that this surely has to have a limited life, or that there are enough people out there who aspire to a different world. And we know there's lots of people out there who are saying this for ethical reasons and maybe even militant political reasons, people who want to overthrow capitalism. And I'm not unsupportive of their vision, but what we've worked out is that in the world of crypto economics, DAOs, DeFi, that it's actually possible to build an alternative inside capitalism, that we are developing a mechanism where we can value outputs that have no price. So the good stuff, the stuff about caring for the environment, caring for people, artistic endeavours, everyone says they're important, and everyone says either they're going to be funded by philanthropy or they're going to be subsidised by the state, state philanthropy. And I think, I know what we're wanting to argue is we can do better than that. We can actually find a way to put a value on these creations, these performances, as we call them, and we can build an economy that substitutes social value for the role currently played by profit.
And with
it's a very big call we've got running here.
Yeah, absolutely. And with social value, you mean basically collectively decided values, which are not given as from somewhere else.
Yeah, I think those of us who formed EXA have a certain notion of what those values might be, but these, and they wouldn't be disputed, I don't think, amongst the sort of audience that would be interested. But it's not for us to impose them. We're creating a space, and the participants in the network will have a say about what those values are. The key to this is going to be, how do you get people to nominate things that they truly value and they want to see flourish in an economy? And how do you give incentives for those things to be produced, and in general incentives around the economic network? And how do you keep that system growing and sustainable? That's the challenge we've had at least in the economic design of this program.
That's right, and I mean that sounds like an economy you're talking about. So let's go a little bit to the difference that we think that there is to what is going on right now in the crypto world, for instance. So in the introduction of the economic paper that we've been writing, there's really interesting like analog of the history of money, banking, and production. Would you like to elaborate on that a little bit, or tell us?
Sure.
Tell us about it.
Look, and what it leads up to, before I say what it leads up to is the proposition that the crypto world has now discovered that finance can be a major tool of change.
Yeah, that's clear.
A lot of people for a long time have disliked finance and said finance is the obstacle to change. Finance equals banking, equals capital, etc. But anyway, to give the run up to that proposition, it was just a very simple little argument that says, we find money as we currently recognise it as issued by states. Money was around about 7,000 years BC, and it took a long time for money to develop into banking, but it did so in the 14th century, in the Italian seaports to fund international commerce. And this was really incredibly elaborate banking, even by today's standards. It was eminently recognisable. And
it was especially to fund the distributed kind of a starting of the trade.
Global trade, and and initially in exotic products, but eventually just trade in cheap commodities and models of processes of arbitrage. But it took then another 5 centuries for the development of what we would now call, or 4 or 5 centuries for the development of what we would now call industrial capitalism, the factory system. And the financial version of the factory system was the joint stock company, the share market, as we now know it, in the mid-19th century. So, and then we don't find until the end of the 20th century that we get to hedge funds, derivative markets, this emphasis on trying to find what's the liquid side of every single asset, that we find massive leverage.
Yeah, but let's stay a little bit. Like, what was the innovation there in the 19th century, mid 19th century, then with the joint stock company and the stock exchange? I mean, they were like organizational forms that were invented.
Yeah, and for eminently opportunist, pragmatic reasons that essentially, as the scale of industry got larger and the funding requirements of building a mine or a textile mill or whatever it was, as those funding requirements got bigger, the individual owners couldn't afford or didn't want to afford to deliver all the funding that was required for that investment. So they invented this fictitious category called the corporation. And sold shares or equity in the corporation. And these were, and it's critical that they were limited liability companies. So those people who were putting money into the corporations, shares, they could only lose the amount that they'd invested. So if the company went bankrupt and people were owed money, they could make a claim on the company, but they couldn't make a claim on the private wealth of the owners. So this was a very decided mechanism to defend risk-taking by capital.
Exactly, and kind of it allowed then that suddenly there was a possibility, and I mean, there was like 200 years of legislation in Britain, for instance, which was overturned suddenly to allow these kinds of things like joint stock companies to operate. I mean, they were thought harmful, not good, and when they were allowed, then suddenly you were able to like gather massive amounts of capital from different sources, then sell it in these little parcels and even have the aftermarket, and it allowed to a totally new kind of mode of production to start to happen.
Yeah, and look, what was important was that initially, after the South Sea bubble and the tulip mania, etc., these things were just thought to be largely unethical speculation. But with the formation of joint stock companies in the mid-19th century, there was an awareness of the power of liquidity and the capacity for leverage. And that these were sort of just a massively defining moment. And we could say that all financial developments over the subsequent 170-odd years have been about refining liquidity and developing risk control measures around leverage, sometimes successfully, but often not very successfully at all. As we know, there are, every 15 years is a financial crisis. So there's always some fallibility in some supposedly infallible system. Yeah,
and then, I mean, it's also important to kind of remember that then that led to when they were finally able to get these massive factories going on, these big projects, projects going on, then they had to invent like wage labor, like things to how to integrate the people into the factories, and a whole new mode of production was actually mode of society was invented.
Yeah. I mean, this connection of labour to the land starts to disappear. Well, in the first instance, of course, we know that labour of all ages and genders was just fodder to the factory. But we also know, and Marx was writing about this by late in the 19th century, that competition, that driving force within capitalism, competition to innovate, reduce costs of production, invent new products, it meant that there was also a focus on on innovation, and that meant skilled labour too. So they also wanted labour that was skilled rather than just muscle.
Okay, so then let's draw analog, like what's going in the crypto world? Bitcoin?
Well, I mean, if we followed that history that started 7,000 years BC, we'd say it started with the Bitcoin white paper. So we're saying what happened in 9,000 years has now happened in just on a decade in the world in which we all operate. So what's interesting then is that we have the Bitcoin white paper, but it's still producing a centralized money system. It's not the state's money system, but it's still a centralized system, and that's probably critical.
But on the other hand, it kind of it did open the question of the that you can do something like that, like money, in a peer-to-peer way, that you don't need the central authority to do it. That kind of opened the imagination, no?
Absolutely, because I think we could say for the last 300 or 400 years, money was defined in terms of the stuff that the state produced, although in fact it wasn't the state that produced it, it was banks that produced it, but it was superintended and approved by the state. And we could all point to communes, community organisations would use their own money, but these were always going to be on the margins, non-scalable, and certainly having no propensity to generalise across even single countries, even single areas within single countries, let alone across the globe. So Bitcoin was, absolutely an amazing innovation that no one before that would have thought or could have imagined.
Yeah, exactly, and it opened the imagination that it revealed the sociality of money, sociality of that, but it kind of did not yet give us the tools to talk about it, to express about it. So that was there. But then, I mean, from money now to what's the going on right now is the DeFi, the decentralized finance protocols.
And isn't that an interesting and rapid development? I think if I were to put a general summary around DeFi, though, I'd say it looks to me like, it's being dominated by incredibly clever, innovative people, but it's largely replicating the financial capacities of currently existing organisations. So it's replicating hedge funds, it's replicating securitisation processes, it's representing leveraged lending, all incredibly innovative and important and necessary, but it is about moving risk around the board, taking it away from those who don't want to hold risk, giving it to those who are prepared to hold risk. And I'll sort of say we hold our breath and say we hope that these risks are being well calculated, because that was clearly the problem in the global financial crisis, 2007. The tools that were being developed were okay. It's just the risk calculations were so grossly wrong or being abused. But we're seeing these developments in DeFi and they're exciting, but they are moving the pieces around and giving access to leverage. And I guess the question that Akseli, you and I always want to ask is, well, where's it all leading? So it means you can get a good return. You don't just have to hold stuff in your wallet. You can now get a return on it. You can now borrow against crypto assets. You can do all sorts of clever things to make derivatives on crypto, break it down into their constituent risks, and trade those different risks in separate markets. That's what I was writing about in the Capitalism with Derivatives book.
Yeah, exactly. So from money to this, let's draw the comparison. So we are moving from money to this from the 7th century BC to these banking protocols from the developed in Italy, in Geneva, Venice, kind of in Florence in 14th century, to the industrial, like the funding of the industrial production. So in comparison, from Bitcoin to DeFi, what? Where are we moving? What is missing?
Well, that's the interesting question. And if I were to draw a connection, because I don't think it's a good answer to that generally. I mean, I know the answer that you and I and Exa are trying to promote, but what's sort of interesting here is that it's not getting talked about. That we know the sorts of people who are being attracted to DeFi, you would guess by and large, are the sorts of people who want the world to be different. And they're probably also the sorts of people who are concerned about the environment, concerned about poverty, concerned about inequality, concerned about care, the arts.
The environment.
Yeah. Sorry, I thought I mentioned that, but yeah, and having global access to technological innovation that doesn't get privatized by large tech companies or put behind paywalls. So the funny thing is, I think that these issues that we've just nominated don't really get a mention in DeFi. I mean, it sort of does. So you'll see DeFi projects designed to fund the environment, or a guaranteed minimum income, or to give funding to various good causes. But the organic nature of finance itself that's being developed in DeFi is not an alternative to capitalism. It's decidedly still capitalist finance done through crypto tokens of various varieties. So I think what inspires Exa is the feeling something's got to give here. How are we going to reconcile these social aspirations with these technical capacities that are emerging, or that have emerged, that we now call DeFi? How are they going to come together to build a new sort of economy, in a sense, in the way that the Industrial Revolution and the Joint Stock Company gave rise to a new form of production, distribution and exchange? Surely there is going to be some possibility of having a similar social and economic revolution, such as that which occurred in the 19th century. And it looks as if, Akseli, we're the ones who are talking about this directly.
Exactly. So this is kind of the general framework, to put it very bluntly, what you're talking about. So there's this growing interest in the DeFi, in the possibilities of programmable economy. We know it's happening. On the other hand, there is this despair, or like hopelessness, even, like what's our environmental situation right now, and they don't seem to match. They don't talk to each other, and that's where
that's right. That's where we're hanging around. That's where we're trying to innovate. And going back to the point where we started this discussion about alternative notions of value, how do we, we know there's a capitalist notion of value, that production is organised around the pursuit of profit, and if it doesn't make profit, it requires state subsidies, or assistance of some sort, or philanthropy. And we're saying, since we haven't got the state at our disposal to be doing the subsidies and the principal forms of philanthropy, and philanthropy, frankly, isn't enough really to shift the agenda of the world economy. Our challenge is, how do we replace or supplant profit as the guiding principle of production? How do we develop an economy in a way that truly attributes a value to the environment, to care, to the arts, to technology? How do we design the protocols for an economy that will reward people for their contributions to areas that in a capitalist economy are thought virtuous but unprofitable, and therefore, are never going to develop a life of their own.
Yeah, so this is the new era of production that we're talking about. Really, like
Yeah.
what is how do we fund this new era of production? And that's what it must come after DeFi. That's the direction. So
You certainly hope so, yeah.
yes. So let's talk about that. Like what kind of finance, what kind of funding, what kind of finance that does this kind of production require? So there are a couple of things that we know. It's going to be about information. It's going to be post-industrial in that sense. Information. We don't exactly know what. So let's start from there. What does it mean? What does it mean that that new kinds of information can start to be accounted, can start to be expressed in the accounting system?
Yeah. Look, the starting point of an answer is to say, clearly we've got to develop some new categories, and there's always a danger with new categories. Are you just inventing a new vocabulary that no one then understands? But we do need some new categories. We also need to recognise that this problem we're talking about, how do you value things that have no price? That it's already a problem in a capitalist economy anyway. That if you look at the largest companies in the world, they're all tech companies, well, with a couple of exceptions. And they all, if you look at UNCTAD, United Nations Commission on Trade and Development, at UNCTAD data, they all rate that over 85 to about 93, I think it is, but don't quote me on that, 85 to 93% of their assets are intangible. How do you value intangible assets? And by intangible assets, we mean copyrights, brands, patents, these things that don't have a standard market. And of course, the accounting professions that are in a real struggle there to say, well, how do you put a value on these things? Because you've got to have a line on the account. So what we're doing is really no different from what capitalism needs. It's just we're freed in our exercise. We're freed from the pursuit of profit, and we're freed from standard accounting practices to actually pursue answers to these questions. And I think the key to the answer here, the key that we have to have is that we need an economy that starts, as you think about it as an economy, not with trade, not with buying and selling, because everyone wants to start with buying and selling and say, oh, we can scale up from buying and selling, and all people will discover money, and once you discover money, people will start issuing credit, and away it goes.
Yeah.
We actually hovered around that path in for quite a long time. But it's sort of, it's not the right path in. The right path in that will get us to solving these problems that we need to solve is that we've got to start from stake. We've got to start from ownership.
Yes.
We've got to start from the notion that processes of production, or what we're calling performances, because we want to loosen the concept of production away from a standard definition of production occurring in a workplace or a factory or something. It can be way more open and expressive, so we use a term like performance. That these performances, if they're staked, what we can look at in terms of a theory of value is how much are people prepared to stake performances that create outputs that formerly have no price. That's the way we get individuals' appetite to take on and back various projects. But we're not asking them to do it, to reiterate, we're not asking them to do it as philanthropists. They will get a return on this. It's just the mode of calculation. We'll be able to say, we can put a value on this output, but the key to putting a value on the output doesn't come from prices in markets, because that's what we're trying to escape. It comes from going back to say, how much are people in this network, agents in this network, how much are they prepared to pay to have a stake? And without going through the logic, because it's quite a complex logic and it involves the use of options and swaps, it's right there in the DeFi domain. we can get to modes of valuing output
So
that I think is incredibly clever.
yeah, so what you're saying, basically, audience is clapping. Just to let you know if you didn't hear. So what you're saying is, let me summarize it, that, and let's continue to that direction, but that we can use the logic of DeFi, we can use the financial protocols to create different socialities. That's what you're saying, no?
Yep. Yeah. So we can say, we can treat the economy as a design space. We can say, well, we can theorize or we can analyze capitalism as one set of protocols. And I've been referring to profit, but clearly it's deeper than profit. But nonetheless, we can treat it as a set of protocols, and we can reimagine those protocols, and we can imagine the notions, the modes in which individuals, either as individual people or as groups, but we'll call them agents as a way of aggregating, agents come up with a good idea. They come up with something that they would like to perform, that they want to test whether it has social value. Will people actually back it in the market? Will people stake it? Will they invest in it? Now, that's not quite enough because you could get your family around who are saying, yeah, I'm happy to put some money in, and hey, if we're going to get a return on it, wouldn't that be fabulous? So it's obviously got to be more complex than that, because that of itself is not a social act. That's just individual acts that are wanting to score points by gaming a system. The sociality comes when we say the network itself as a whole has to have mechanisms to determine what the values of these various outputs are. So you or I might stake something as individuals, but the thing we're staking, the risk we're taking, is what will the rest of the network think of this output? Will they say, of all the things out there, we're prepared to reward this because we think it's a social contribution? Or will they be saying, well, you think it's a social contribution, but as a network we don't. So it's still got a competitive edge to it. You've still got to meet social criteria, but these are social criteria that are expressly designed consciously by the network, unlike profit, which for some reason is just inherited historically from 300 years ago, and we don't really challenge it deeply. So we're just opening up those presumed norms. We're opening them up to say we can make these conscious, intentional decisions right now.
So exactly, and what the technology kind of allows us to do is to start to actually open the question of valuing these intangible, relational, affective things which don't find an expression in the current economic grammar, in the economic way of talking about things.
That's right. So just to go back a little bit, it requires the use of options, and it requires the use of swaps. And to elaborate just a tiny bit, because this could easily run into levels of complexity that are going to raise more questions than it answers. But if you think about stake has option-like characteristics, because it's taking an exposure, it's buying an exposure. When you buy a stake, you don't get to control the production process because, hey, someone else is doing that. You're just buying it as a stake in it, sharing in the success or failure of it. But it has an option-like dimension. And I'll have to come back to one little element that's important. But the swap element is also important, because what we're wanting to say is individuals can go about producing their own performances. But if we actually design a system where all agents in the network, all performances, shall we say, swap part of their return with the average return, the general return on the network, so there's a risk-sharing process, then we can actually design processes in which the social incentive, even though ownership is individual, there is a social incentive to to produce outputs that will generate social recognition, social value, because the rate of return on that investment, on that staking of those performances, the social return on that has been at least partially converted into a general social return, so that everyone has a vested interest in everyone else's success, and your own success will just be partial.
Right, and what you see going in the background, what you are talking is that we have like the financial logic of these instruments, that we are using them. We're using them to redirect risks, flows of risk, flows of upside. Kind of how do you share them? How do you share the upside and the risks? And that's kind of for what you can do with these instruments. So that's why the my next question was that, yes, why what makes these financial instruments so like adequate or kind of so interesting that you can organize things with them?
Yeah, just before gee, that's a hard question. But just before I answer that,
That's the important one. That's the important one.
It is the important one. But that people watching this may note that the way in your little summary there, you're using exactly the words that you'll hear in DeFi. So we are doing DeFi, but we're doing DeFi to a particular purpose.
Exactly.
And that's what makes us different. Now I've gone and forgotten exactly the question you asked, but I said was difficult.
Yeah, like what makes this what makes the financial technology or the, let's say, derivatives,
yeah,
like an adequate way, or kind of not adequate, but interesting, and that we must use them, in the sense that we know that also the post-capitalist economy will be financial.
Absolutely, it'll be financial. Well, what's fabulous about derivative finance, I think, and fabulous in every sense of that term, what's fabulous about it is that it means things that we once thought as a whole, whether it's a factory or whether it's a bond or whether it's your household, that if you think of these as a financial logic, you can break them down into their various exposures. And what you can do with a derivative logic is you can make a conscious choice. Which risks do you want to hold and which do you want to lay off? And this provides a mechanism then by which we're saying we decompose or we dividuate things into their attributes. We don't necessarily have to put them back together. They live in the world. The factory, the household lives in the world as a whole. But financially, we're just decomposing them into their different attributes. And this is what DeFi is doing. It's what we're doing. We can reconfigure which of these risks do we think individuals should hold, and how do we design protocols to hold those, but which should be socialized. So it's actually a conscious attempt.
Risking together.
It's the risking together ethos. But it's a very conscious choice in protocol design to say, hey, we're not trying to centrally control anything, but let's put together the protocols that have a conscious allocation between the individual and the collective. And I think one of the things that we could say we've observed over the years is that in the crypto world, the propensity to gravitate towards individualism has been really strong. Decentralized, distributed, powers of agents, etc. But if you want to build a different society, you've actually got to also take account of the social. We're not going to get to a different society just by doing capitalist stuff more efficiently, or without a central agency to issue money or to clear trade, etc. Sure, those things can be done different, but they're not going to make a different society. So we've got to use the power of derivatives to make conscious protocol design choices about how to configure incentives to match the social and the individual.
Exactly. So it is really a technology to manage, not only manage, but to actually to design the way that you want to do things together, the way that you want to share the upside and the risks of what you're doing. And that's kind of it's very simple, in fact, but when you understand it, it's powerful.
It is powerful. And just one other little caution that I think should be added at this stage, because some people watching this might say, that sounds like centralized control, that are imposing the social. But it could be. But the way we're designing it maintains the integrity of a distributed logic, because we're all the time saying the level of the social should itself be subject to evaluation by individual agents, and their offers and acceptances to the network should be what guides the definition of the social. So we're designing something here which has a social element but no imposition of a particular version of the social. And I think that's a pretty amazing thing to be able to do.
Yeah, absolutely.
To have the social without the state.
So what are then the consequences for, okay, let's say, so in that sense, it's like a grammar really to express things. So what are then the consequences to decision making, or to the, like, compared to the, how decision making under uncertainty is thought in finance. I mean, this starts to point to a different kind of governance, a different kind of not only attitude but different. I can't find the word, like different way of being in the economy.
Yeah. Look, I think that's right, and the way I was talking about derivatives, people watching could be saying, well, that's familiar, and we understand that through mechanisms of decision-making under uncertainty.
Yeah.
Which is a familiar concept in economics and in finance. It's like, yeah, there is decision-making under uncertainty, but the thing about decision-making under uncertainty as a mindset is that it's static. It's about saying, here we face a particular optimizing decision. Do we go down path A or path B? How we calculated the risk, the future scenarios. But what we're more concerned with is the dynamics and the openness. Decision-making under uncertainty says we recognise there is uncertainty out there, and we want to, in a sense, analytically close it down to make a decision now. What we're trying to do is to say we want to focus on potential. We want to focus on flows. We want to focus on these performances, processes of production, processes of creativity. We want to see what they can produce, how they can innovate, how they can build a new social, well, I was going to use the word order, but I don't like that word order because it's quite an authoritarian sounding word. But, a new social potential. And in that sense, we've got to get beyond the mindset of conventional finance, decision-making under uncertainty, and move towards flow notions. This idea of being motivated by being animated in the game, feeling involved in a future, building a future, not doing this cautionary exercise of, well, how will the accounting look? Did we optimize, or did we make the wrong decision? This is all about risking. This is all about potential. But if you build in the structures of risking together, of socializing those risks, the act of risk-taking can be much more liberating. It can be much more focused on the upside, with reservations, because the network has to say, yeah, that's a good risk to take. We'll back you in that risk. But it's always pointing to the opening of potential rather than have we managed the uncertainty of the future in the optimal way. And they're very different mindsets.
Yeah, it's a different mindset, and that's kind of what we are trying to, what we're seeking. Like after DeFi, after decentralized finance, it's this space of finance, like not only like trying to optimize, trying to arbitrage the prices, making more money in with some other protocol, but rather, what are the ways that we could start risking together to open up different futures? That's
stuff that we've never thought of. That we just want to create. We want to create the space for it. Yeah.
That's what needs to come after DeFi.
Yeah. So that's what comes after DeFi, we hope.
Yes. Good. So we have a question. I'll turn you around.
Hello, everyone.
Hi.
Off in the distance. Yeah.
Hi, thank you so much for this super interesting discussion. Unfortunately, I missed the first part, but I was wondering whether you could expand on a few points. So is what you are proposing similar to, or how is it different from a variation from existing social impact bonds? Secondly, if we're going to be talking about really imagining a different economy that's beyond profit, I'm quite curious about derivatives and options, because basically they're legal contracts based on property rights. So I was wondering whether you could address these issues a bit more. Thank you.
Sure. Hey, thank you. They're both really interesting questions, and the social impact bonds question is right on the money, in the sense that when we looked at these, they actually have a really interesting formula for them. Clearly, current social impact bonds are centred on the state, and where they've been utilised, they've by and large been underwritten by the state. So they talk the talk of risk taking by the investor, but often it's heavily subsidised. But hey, that's a separate issue. But the notion is that in a social impact bond, that an investment will be undertaken because the state doesn't want to undertake that investment, but the state wants to pass the risk over to a private agent. But then the state takes the information, whether it's out of home care or prisons or whatever it is, the state takes that information and can actually then design policies. They can take on successful social impacts and design policies for the future. Because you can't keep having a social impact bond about the same issue over and over again, because then the risk's gone out of it. So there's a sense in which there's somewhat of a parallel there, but in a social impact bond, it's the state that draws the limit and the state says, we want to know about this, and we've seen the result of the experiment in the social impact bond, and we are going to take up this policy or not. Of course, in our economy, we have no state. So what we have is the rest of the network that is going to be the adjudicator on as to whether something is a good idea worth supporting or not, and it will support it on an ongoing basis. So there are elements that are parallel in the design, that there are three parties. There is an investor, there is a performer, and there is an evaluator. And in a social impact bond, the investor and the performer have to be different, and the evaluator is the state. So where there's no state, it doesn't work, but the triangle is there. So in that sense, it's not vastly different. But that's a really interesting thing to note, that parallel. Then the second question, and Akseli, you might like to pitch on this, that derivatives are contracts, absolutely, and the governance of an alternative economy must be centred on the rights of agents who are parties to these contracts. And the fact that these will be explicitly posed as contracts means that if they're properly designed, the rights, responsibilities and risks of each party should be made absolutely explicit. But in asking your question, did you want to draw out, you were, I suspect that's not quite a rich enough answer for what you're asking.
Well, property rights are basically guaranteed by the state, right? So,
Sure.
You know, this thing belongs to me, and if you, let's say I have a car, if you try to take my car, which belongs to me, I have the recourse of, getting my car back or something along those lines. And that's guaranteed by the state. And contracts, as we know, exist. Okay, when things are going well, all is fine and everyone is happy. But contracts, by definition, exist because of potential conflict. So the question is, who comes in when things fall apart with these contracts? And also another point I forgot to make, this idea of risk, I think what you're proposing is actually something beyond risking together. I think what you're proposing is actually thinking beyond the idea of risk. Because when you think about it, poorer people can't afford to risk. And we always like to think, for example, nothing to do with money. For example, during the Arab Spring, probably people in Syria were thinking, things are so bad, we have nothing to lose. And then look what happened. Things can get worse. So, sure, we can be an optimist and think, yes, let's risk together and we can do something good. But at the same time, I think it's really important to consider the flip side of risk.
Absolutely.
Yeah.
Okay, let's go there a second. But before, let's answer the first question a little bit more. Like, so how do shadow banks handle it?
Yeah. So because in a sense, shadow bank, one of our claims is that every agent can be a shadow bank. So just a couple of these things on guaranteeing contracts. And these will be a few really sweeping points, but it's not appropriate to elaborate in too much detail. First of all, this economy we're talking about, it actually operates inside a capitalist economy. So it's not a sect or a cult existing on the edge. People will operate in both economies, both the capitalist economy and this alternative economy. So all the rules of the state will of property rights will still apply. Having said that, the point you're raising is really important, and what Akseli's gesturing towards is that when we're talking about an economy of staking, we're also talking about an economy of mutually issued credit, but collateral is a key to this economy.
Exactly.
That all loans will be collateralized, and if risk is diversified, if ownership, if staking is diversified, if the only way, and this is getting into more detail than was appropriate in a short talk, but I've got to just raise it here. If there is an incentive for every agent mounting a performance to sell off stake in their performance, there is also an incentive for them to acquire stake in other performances. This is the notion of risking together. So you haven't got all your eggs in one basket. All credit is collateralized, collateral is diversified. So there are protective mechanisms. But of course, you can never have the protective mechanisms of the state, but there will be a liquidity pool that Exa Finance runs, and I just can't elaborate that there. So that's getting some of the way towards those questions that you're talking about. But in the context of the Arab Spring parallel, that poor people just don't have, they might have nothing to lose, but poor people can't afford to take risks. Well, I sort of beg to differ, because I think everyone in a capitalist economy is asked to take risks. They're never framed that way, but you're asked to go to work. You've got to be a person whose health might be variable. You've got a person whose employment is not guaranteed. All those sorts of risks we currently have. So we shouldn't think about a world where people only choose to risk by being speculators. You can't not be a speculator.
We are already at risk,
Yeah, either your rent's going to go up or go down. You hold a house that'll go up or down in value. All those. But having said that, I think what we also want to design, and this is where the risking together issue comes from, even though I take your point, there's more here than risk, but the togetherness issue is that if you can set up protocols to ensure that everyone is encouraged to risk, because part of their risking is underwritten by the network as a whole. That the whole purpose for this network is not there's no possibility of saying, let's get all cautious and let's put it all into treasury bonds, or let's put money in mattresses under the bed. there's no money like that. So the whole notion, the whole momentum of this alternative economy is to say, we've got to take risks. We've got to take calculated risks. Everyone has to be involved in risking. But if risking is done together and in a coordinated way through a network, then the poor and the less poor can share the consequences, and there can be mechanisms.
So
we
the
call it
risks can
guaranteed
be
minimum stake.
Yeah, so they
There
can
are
be
mechanisms to
the risks can be distributed in a different way. That's the what we're trying to say. And there are mechanisms like, and the collateralization. And if you think of the key thing from for about capitalism as a financial system, there are a couple of key things that it holds onto. Like, what is liquid? What is liquid, and what is collateral? What counts as liquid and what counts as collateral? And these are the questions. If we can start to address these, open those up, then we are talking about a post-capitalist financial system.
Yeah, they're good points, and they're what we say defines capitalism as a financial system, not an economic or a social system. As a financial system, it's who gets to declare collateral and who gets to define what an asset is, and we say, hey, we want to break the rights that go with those questions. We want to break those open.
Hi, I'm Jon Sundell. The notion that this is possible within the existing capitalist system and the monetary system, obviously, from my perspective, the structure of our financial system is so broken is the wrong word, but it's sort of like beyond repair when it comes to like an average person's interests. I think that it's a very sort of exploitative system, and so even if you are able to sort of create something within it, you can't in a way negate the structural problems that the monopoly of issuing money, for example, that is something that when you're trying to sort of have social value and bypass profit in these sort of things, I sort of question if it's possible, and while I think that I would really like to look into these options and swaps and all these things that you use as a tool to address these things, I also think that they are not accessible sort of mentally to the average person who really has a problem sort of even understanding simple sort of equations, compound interest and stuff like that, and so to sort of require them to be fluent in sort of risk allocation and commodification and all these sort of things, I think that there's this saying, if it's not accessible to the poor, it's not radical in a way, it's a very sort of like a cerebral sort of minority that has access to this kind of strategies.
Okay, no, they're really good points, and thank you. So on the first thing about money and control of money and the financial system, yeah, it's interesting the things you leave out when you have a discussion in a talk, because critical to our analysis is that there is not formal money as everyone is used to. We have mutual issuance of credit. So there it involves no banking. It involves fiat currencies. The state's currency can enter this system, but it comes in as a commodity. It doesn't come in as money. So people can use it, they can buy it and sell it, but just as you'd buy a sack of potatoes. That's how money exists and how these two economies interact. But look, I won't go into more detail. I could, but that would just take a bit long. Sorry, Akseli,
I'll give him the paper to read. Don't worry, man.
Excellent. So look, on the issue of options and swaps being cerebral, and if ordinary people, poor people, don't get it, then there's nothing radical about it. I think the thing to say there is we need to talk about it at that cerebral way, but we could also talk about daily life as dominated by options and swaps. You know, when you take out a loan, do you take out a fixed interest rate loan or a variable rate loan? When you go to the shop and you put something on hire purchase, or you put something on lay-by at a shop, these can all be re-specified as quite complex financial contracts that people just do in their daily lives, never thinking about the analytical propositions that lie behind them. So all I can say by way of a really short answer is, if we can't program this in a way that makes these options and swaps look like common sense choices, then we will have failed. Because, you know, I think in a forum like this, we've got to talk about, you know, what lies under the hood. But people actually are just going to drive the car. That's the aspiration. Having said that, I take your caution that when this gets communicated, it's got to be done in a way that doesn't invoke, you know, highly sophisticated finance. But I would just want to reiterate, it's already there in our daily lives. We just don't recognise it in those terms. So when you redesign the protocols, you actually have to use the same techniques but flip them, and you've got to expose what they really are. Yeah, so it's more like the logic, the logic we are able to describe and think about the logic, the protocols, the financial protocols, which it's just important. We need to be able to like open access to that grammar, because it's really powerful. You can do powerful things. But then, I mean, think about TikTok. That's more like it, that it's going to be. Like how do you engage with these risks and these options? It's more like that. Everybody playing, connecting with others, opening up opportunities. Everybody reading, writing, seeing what others are doing. That's the sense of it.
Okay, and I really hope that that's what happens. What I'm afraid of is that when you can sort of like partial risk and allocate it different way, I just think that what has happened in the past, and I suspect will happen in the future, is that the unsophisticated people, are going to be, talked into contracts and situations that, like payday loans, for example, if they would, like it's a very, poor people, they are like forced to make bad contracts, over and over again. And I just think that as long as I just think that there are going to be people who are going to be left holding the bag. Certainly. And there's going to be this group of very sophisticated people who know how to write these contracts and, in a way, extract value from this crowd without this crowd knowing. And I think the tech companies that, we're talking about, they are really excellent at extracting value, and sort of it's sort of endemic of what's going on, and I hope that you can address it, and because I think that's exactly the aim, man. Yeah. Hey, and look, I think it's a really important statement, and we know that by and large, poor people don't have wallets. Poor people aren't trading crypto. They're not involved in DeFi. But I think what you're saying is a really important caution about the direction DeFi is taking. What's going to stop it just becoming predatory? But let's just say, I believe that what we're designing in EXA is cognizant of that. So there's credit, but there's no interest payments on credit, and it's motivated
It's deeply motivated by the desire to avoid exactly the cautions, not to avoid the cautions, but to take account of the cautions that you're raising. And I think one of the things we're looking for amongst people reading the white paper is, can we believe that we're not vulnerable to that problem? But hey, it's really important that lots of people read it and scrutinise it and say whether that's the case or not.
Final comment. Maybe the way to address it would be to build these sort of simple products that sort of combine sort of so many best practices that even an idiot can sort of like that if there's a foolproof sort of contract that you can enter which sort of protects your ass and your assets and your and allocates risks in a way that a very sophisticated person would do it, and then you can if you're more sophisticated, you can sort of like adjust and make riskier bets and stuff like that. But I think that it needs to have like these best practices that most people are sort of like in the same. Their ability to take on risk and stuff like that is limited, and in a way, in somehow that way to make it accessible, easy to understand, and make sure that the smart people have been looking out for the little guy, and if you can sort of bring those kinds of products to market, I think that then you're onto something.
Yes.
Yeah, and I think that I agree with you entirely. So I could just say, while we're promoting an economy based on ownership because it's critical, skin in the game of decision making is critical to get the information flows that are going to make this economy run. So you want ownership. You don't just want prices, because prices give you one-dimensional information. You want more detailed information, you want skin in the game, but you also have to make sure that people don't lose their skin. So if I said to you, for example, the swap element, without explaining it, the swap element means agents in this system always have a guaranteed minimum stake. You can make bad decisions, but there's going to be a stake safety net in this system. They're the sorts of things that we can build in. Frankly, when you've got ownership, you can't guarantee everyone has exactly the same returns to ownership, because then you don't get the incentives of ownership. But we can make sure that these aren't extreme. We design out the incentives to accumulate massive wealth. There's no mechanism to accumulate significant wealth. There's no mechanism to lose all your wealth in this system. So I'm just trying to say, we're aware of this. Whether we've solved them well or not, others will judge.
Yeah, and it's a design space. That's the key.
Thank you, Dick.
Thanks, Dick,
for a really wonderful
Thanks, Akseli.
talk. And I was just thinking about decision making under uncertainty, and it's all about risk and potentiality. And it was like very familiar to how we were building up this event, and then just jumping into the flows and potentials. So, but coming back to the issue that was discussed, we also have produced this primer, which has like economic literacy basics for everyone. So I think it's also an important thing to start with, and it's still just the start. So thank you for everyone. This was a great morning, and we will have an open mic in the afternoon, so you can join it either here at Audi, or we will also publish how you can access it online on our website. And yes, see you soon. And the evening event then is the session is about governance, and starts at when did it start? 5 in East European summertime. Great, thank you.
Thanks, Minna.
Thanks, everyone.
Dick?
Thanks.
Thanks. Very good. Ciao.